Warren Buffett's annual letters to shareholders are legendary, right? But the one from the year 2000, the one he wrote right after the whole dot-com bubble burst, that one's different. It's not just some historical document. It's a truly timeless masterclass in business, in value, and in just plain rational thinking. And honestly, it might be more relevant today than ever. So let's jump in and unpack the lessons from one of the greatest to ever do it. Okay, to really get the Berkshire Hathaway story, you've got to start right here. Just look at this scoreboard. From 1964 to 2000, the S&P 500 did great, a return of over 5,000%. Fantastic. But Berkshire, get ready for this. They delivered over 200,000%. No, that is not a typo. The difference is so massive it's hard to even wrap your head around.
So that wild result brings us to the big question, doesn't it? Think about the time. We're at the peak of the dot-com mania. Everyone is going crazy for tech stocks, the new economy. And then you've got this company, and what are they buying? Bricks, carpets, paint. How in the world did they pull off one of the best financial runs in modern history?
To figure that out, we're going to break down the key pillars of their success, pulling them straight from that 2000 letter. We'll look at the scoreboard again, then dive into their, let's call it, unique strategy of buying bricks and carpets. After that, we'll uncover the secret sauce, insurance float. Then we'll get into Buffett's whole philosophy on investing versus just gambling. And finally, we'll wrap it all up with a big takeaway.
All right, so that scoreboard, that result, it's not just some random number on a page. It's the end product of a really specific way of thinking. And to get it, we've got to look at the first piece of the puzzle. What on earth was Berkshire actually buying at the turn of the century?
So, pillar number 1. While everybody else was obsessed with clicks, Berkshire was all about bricks. And yeah, I mean that literally. This gets to the heart of their first big strategy, how they went about buying businesses.
I love this quote from Buffett himself. You got to appreciate the humor, right? He knew exactly what he was doing. He wasn't trying to be cool or glamorous. He was just laser-focused on one thing, buying really good, simple-to-understand businesses for a fair price. It didn't matter if they were old economy. He wanted companies that would be around for a long, long time, whether they were selling paint or jewelry or work boots. And this really highlights the huge difference in how they operated. On one side, you have the Berkshire way. Buffett called it just answering the phone. They talked to founders, to families, people who loved their business and wanted to find it a good, permanent home. Then you have the total opposite, the typical Wall Street way. It's an auction. It's about financial owners who just want to shine up the business to sell it off fast for a quick buck, without really caring about what happens to it down the road.
Okay, so they're buying all these solid, if maybe a little boring businesses. But where did the money come from? How did they afford all this? Well, that brings us to pillar number 2, the secret financial engine that made everything possible. It's a little concept called insurance float. So what exactly is float? Buffett's own definition is perfect. It's money they hold but don't technically own. See, when you run an insurance company, people pay you premiums before you have to pay out any claims. So you have all this cash just sitting there, cash you get to hold and invest for yourself, sometimes for years and years. It's an incredibly powerful idea.
And we're not talking about a little bit of money here. The scale at Berkshire is just staggering. By the end of the year 2000, they had almost $28 billion in float. Just think about that. It's like having a giant loan that you don't have to pay interest on. In fact, if you run your insurance business well, you might even get paid to hold the money. This was the absolute rocket fuel for everything else they did.
And look, this wasn't some lucky break. You can see the growth here over decades, and it's just explosive. It went from $20 million back in '67 to nearly $28 billion by 2000. This right here, this is the power of compounding in action, all driven by their insurance businesses. So having this giant pile of cheap cash to work with was obviously a massive advantage. But the advantage is only as good as what you do with it. And that brings us to pillar number 3, which is really the core of Buffett's entire worldview, the crucial difference between investing and just plain speculating. Believe it or not, Buffett says the secret to valuing a business hasn't changed in over 2,600 years. It all comes back to this one ancient fable. Of course, this being Buffett, he puts his own very practical spin on it. And here's the genius of it. He takes this old saying and turns it into a simple, powerful checklist. For any investment, you just have to ask 3 questions. 1, how many birds are in the bush? Meaning, how much cash is this thing actually going to produce over its lifetime? 2, when are you going to get that cash? And 3, what's the risk-free rate?
What could you get just by sticking your money in a super safe government bond? That's it. For Buffett, that's the whole game. Doesn't matter if you're buying a farm or a tech company.
Then he uses this brilliant analogy, he calls it Cinderella out the ball, to explain why even smart people get caught up in bubbles. Everyone at the party knows it's going to end at midnight, that things will turn into pumpkins and mice, but the party is so much fun that nobody wants to leave. They all think they can sneak out at 1 minute to 12. The problem is, as Buffett says, in a market frenzy, the clocks have no hands.
So, looking back at the dot-com crash, he pulled out some lessons that are just as true today. He warned that a lot of so-called business models aren't actually creating any value. They're just moving money from one person's pocket to another's, kind of like a chain letter. And his biggest warning, speculation is most dangerous right when it looks like the easiest thing in the world. So let's put it all together. You've got this intense focus on real, durable businesses. You've got the incredible financial engine of insurance float, and you top it all off with a super disciplined, rational way of investing. What you end up with isn't just a handful of good ideas, it's a whole culture. A culture of clear-headed thinking that let them stand firm while everyone else was losing their minds. And all of this leaves us with one big question to think about. I mean, this letter is from over 20 years ago, but it feels like it could have been written yesterday. In a world that is still completely obsessed with short-term gains and the next big thing, what's the real value for you, for me, for anyone in patiently and rationally playing the long game?